Welcome to Crescat's Market Call, featuring our macro and activist mining research. I'm Kevin Smith, Crescat's founder and chief investment officer. Before we get started, please read through our important disclosures being shown now. These and additional disclosures regarding the risks involved in the type of investments we will be discussing, as well as the fund's performance, can be found on Crescat's YouTube channel or on our website using the QR codes on the slides. The type of investments discussed on these videos can carry significant risks, including risk of loss. The videos are intended to be general discussions of macro investment themes, the mining industry, and news with respect to the companies in our activist metals portfolio, and are not intended to be investment advice or an offer of investment advice or services. Crescat's managed funds only accept accredited investors, and the discussion in these videos has been prepared with that level of audience sophistication in mind. Any forward-looking statements may or may not come to fruition. If you enjoy our videos, please click on the like button and make sure you are subscribed to our YouTube channel to get notified of upcoming episodes. You can also follow Crescat Capital on X for ongoing macro research and important news updates on our activist metals positions. If you want to learn more about Crescat's investment strategies, we encourage you to reach out to our head of investor relations, Merrick Iwahashi. His contact information is on the screen now and can also be found on our website at crescat.net. Welcome, everybody. So today we have all three of us, myself, Tavi, and Quentin. We're all live, and it is August 22nd, and here we are approaching new all-time highs in the stock market once again for the NASDAQ 100 and the S&P 500. Now on hopes of a Fed rate cut coming up in September. Jerome Powell kind of caved in basically today, and the Fed can still change their mind based on the data, but he's definitely signaling that the Fed is leaning more towards the slowing economic data and high as opposed to the higher inflation. They face risks on both sides of things, but there's pressure to cut rates, and it looks like that's the direction we're heading in. Normally, when we have rate cuts, it signals that there is economic slowing, economic weakening, and that's what they're favoring now. But what's the problem? We are still, at record all-time high valuations in the stock market. I know we've talked about this, for the last several years already, because we've been at high valuations for a long time, and they've only gotten higher. But it is a risk. And this chart here is just showing a variety of U.S. stock market indices, and in particular, the NASDAQ 100 and the S&P 500 are the ones that have 95th percentile range valuations on the next 12 months forward-looking PE ratios. So forward-looking PEs, which have pretty high earnings estimates, by the way, are in high margins, and assuming continued growth in earnings is what's all baked into the forward estimates right now. We're at record valuations. Let's not as bad in the Russell 2000 and the equal weight S&P and the mid cap. So it is a concentrated large cap, overvalued market. That's important to understand. But let's go on to the next. This is similar to a chart that I have shown that is focusing on valuations relative to GDP. When we focus on valuations relative to personal income, it's a similar kind of a measure, but it really shows the extent compared to the 2000 tech bubble, which was also a large cap stock market bubble. It really shows how much more extreme this valuation the valuations are today, compared to looking at it in a PE sort of way or price to book. It really illustrates that we are even more overvalued than that 2000 tech bubble peak and that 2021 peak as well. Let's keep going. Here now we can look at valuations in the U.S. Compared to the rest of the world, and you can see that we're above the 90th percentile in U.S. valuations. When you look at using the MSCI indices, and but look compared to these other countries, whether it's Japan, the Europe, the emerging markets, the United Kingdom, the world markets ex-US. The U.S. markets are at record valuations, not only relative to themselves and relative to other countries. So important to understand. Let's keep going. Price to book, just another way of looking at valuations. Price to book values at record highs today, higher than the 2000 tech bubble. Let's keep going. This is a nice chart because it goes back to before 1929, and you can see that looking at the top 10% largest U.S. stocks, by year, going back to the 1920s, and the market cap, again, this is showing the top heaviness in market cap of the stock market indices at large, and you can see that the market cap concentration of the largest stocks, representing the largest percentage of all U.S. stocks, going back to 1929, at the highest levels ever, and higher than 2000, higher than 1929. Just another indicator that we are at record valuations and a record, I would say, record risk of stock market correction because of valuations. Let's keep going. This is from David Rosenberg, just showing that margin debt in the U.S. in customer securities margin accounts is at an all-time high. And, these are, of course, margin debt comes down as you're going into a big correction and people are selling stocks and getting margin calls. But it's another illustration of the risk at record all-time highs and record valuations for, that we're also a record margin debt. Let's keep going. I've shown this chart a few weeks ago, maybe a month ago, I forget, but we've updated it with the recent month's performance. And what it's showing is the Crescat Global Macro Fund, which has a track record going back to January of 2006, so pre-global financial crisis. And what the downside capture ratio that we're showing here in this chart illustrates is that when you have, if your fund has positive returns in down markets, just looking at months when the benchmark was down, and you have a negative downside capture ratio, that means you're going up. Your fund has gone up on average in down markets. And that's the meaning of a negative downside capture ratio. So the Global Macro Fund has a negative downside capture ratio going back to 2006 when it was launched. And so that's pre-global financial crisis. This is a fund that has been through the global financial crisis, and it's still around today. We have positive returns earlier this year in February and in March when the U.S. stock market went down. We're a global macro fund that's not afraid to have short positions on, and we've been able to capitalize on that. So, as an example, what these numbers mean. For example, a downside capture ratio of minus 41.8% versus the S&P 500. That means when the S&P 500 fell 10% on average, our fund gained 4.2% on average. Similarly, a downside capture ratio of minus 84.4% versus the HFRX Global Hedge Fund Index shows that our fund on average since inception going back to 2006 has gained 8.4% when that index has fallen 10% on average. While past performance is not a guarantee of future returns, with the U.S. stock market at record valuations and at risk of a major correction, we think investors should be on the lookout for funds with a proven track record of delivering positive returns in down markets, i.e. a negative downside capture ratio. Let's keep going. So now we're looking at all discretionary global macro hedge funds. According to the eVestment database, that have been around since at least January 1st of 2006. That's when we launched the Global Macro Fund. It was prior to the global financial crisis. So these we're looking at all discretionary global macro funds that are still around today and that were around pre-global financial crisis. A lot of global macro funds didn't survive the global financial crisis in 2008, but these are the funds that have. And when you sort them by two different measures, so average annualized returns since inception, and by downside capture ratio. So we're looking at two dimensions. We want to, the funds that would be in the northwest quadrant of this scatter plot, would be the ideal spot. The most protection in down markets and the highest overall absolute returns is what it's showing. And and here's for this is the downside capture versus the S&P 500 that we're showing now. And so you can see, our fund has had about the same overall annualized returns of the S&P 500 index, which is at record all-time highs and record valuations, and has had an enormous run-up since the global financial crisis. But it's we've delivered about the same average annualized returns, but with a negative downside capture ratio. So we've also delivered that protection in down markets, and this is what a global macro fund is supposed to be. You can see that another prominent discretionary global macro fund, Bridgewater, their Pure Alpha Fund 2 and Pure Alpha Fund are also make this list for negative downside capture protection in down markets. And but Crescat has actually outperformed those Bridgewater funds on both measures: overall average annual returns net of fees and the negative downside capture. So like we said in the prior slide, now I think is the time that investors should be looking for funds that have this type of a risk profile when the markets are at all-time highs. And so let's keep going here. We talked about how the precious metals fund just achieved its 5-year track record. So again, this is a non-correlated fund, non-correlated to the S&P 500, and it's one of the top performing industry or sector focused funds among all different sectors, but certainly among resource and mining type funds. And we just got our final numbers for July. It was estimates that we were reporting on earlier in the month, but now we have the final numbers, and they were actually a little bit better than what we had put out for our initial estimates across all of our funds, actually. And so these are the final numbers, and again, we've been outperforming the benchmarks here for the precious metals fund, and very excited about the opportunities still ahead for this industry. This is an industry that has gone through a 14-year bear market. Talking about the equity industry for mining stocks, and especially the exploration-focused mining stocks, where our portfolio is heavily tilted. So let's go on to the next. This is looking across all 5 of our hedge funds, the global macro, the institutional macro, which is our qualified purchaser version of our global macro fund, our long short fund, the precious metals fund, and the Crescat institutional commodity fund, which is again the qualified purchaser version of our precious metals fund. Both the Crescat Global Macro Fund and the Crescat Precious Metals Fund have reached their 100 U.S. investor limit, and so we had to open up these. We had to open up these 2 institutional funds to be able to take on new clients. Otherwise, those funds are closed to new U.S. investors for all practical purposes, because we don't have any more slots available. Is why we opened those funds, but they're very similar to the Global Macro and the Precious Metals Fund, that are 2 institutional funds. We have 5 of the top 10 performing hedge funds year to date in the whole Preqin database, and there's 1,300 funds almost that have now reported their performance year to date in the Preqin database for 2025 year to date performance, and we got 5 of the top 10. Past performance is no guarantee of future returns, but I do believe that we are early in the cycle for a number of our macro themes. We've talked about the short positions in the global macro and the long short funds, and how those funds have been able to be true hedge funds that actually short and have delivered that negative downside capture ratio. And then we have the precious metals and institutional commodity funds, which are more long only funds today. Those funds can short. There's nothing preventing us from shorting in those funds. We just choose to be long today, and have been long focused since inception, due to the ultra low valuations and the upside opportunity in that industry. So we got a special treat today, because Tavi has just taken the lead on our investor letter that should hopefully be going out tomorrow morning, and he's got some awesome macro charts in there to feature. And then we've also got Quentin today live to do a full update and a special treat for you today, which I won't spill beans on. So let's keep going. I had one more chart. I'm sorry. This is just our overall returns across all our funds and strategies. You can go to our website and look more at the returns and the disclosures, but we have the final numbers now for July. So let's get on to Tavi.
All right. Thanks, Kevin. Well, let's get started. I think we're not in the very beginning of the presentation here, Trevor. Yeah, there we go. So this is let's get started with some thoughts on what we wrote recently, and also some of our views. The chart evolves around the dollar a lot, and today is a good day to talk about that, because the dollar is certainly devaluing versus other fiat currencies, and that's our view that's we're likely going to enter a long-term period of devaluation of the dollar that could trigger a lot of ideas. We talked a lot about metals and mining, but I'll talk a little bit about AI as well here, because I think it's important. But I think not a lot is talked about when we talk about deficits. A fiscal deficit is all over the news, and the fact that government spending is one of the largest we've seen in history. But what about the trade deficit? Trade deficit, which we know Trump is going after that through new trade agreements and tariffs and so forth. But this certainly looks like a structural problem when you look at the chart over a very long term. I don't think we face anything. And I like to look back in the 1940s or 1970s often, and I'll do this again in this presentation. But are those real comparable periods? Even the 1940s, look at this chart, and you can see that the current account of the U.S. relative to GDP was actually much more of a surplus than even a deficit at that time. Is that really comparable? And when you think about a country, it's got two ways of making money. I'm simplifying, obviously. One way is to collect taxes. And we know that we're spending more than what we're collecting in taxes. And the second way is exporting more than importing. We're losing in both ways. We call this a twin deficit. And so basically think about this as an exponential growth of the debt, given the fact that you're running a double-digit twin deficit today. So it's about 5% of GDP on the current account, plus another 7, you get about 12. And so, look at this chart. The only time we've seen something close to this type of trade deficit was in the 1800s. But in the 1800s, the U.S. was really going through sort of its emerging market moment, right? It was receiving a lot of capital from the UK. It was a large, believe it or not, it was a large importer. How did it fix it over time from the 1800s to go from a severe deficit to a surplus? Agricultural commodities actually was a big part of that period that helped the U.S. to get out of that situation over time. Today, we're much more maturing than an emerging market, obviously. We can say, and I should also point out that, you're facing not just the current account issue, you've got the fiscal issue, and you've got the debt problem already at all-time highs. And so, it's really those three imbalances. And then on top of it all, you've got a dollar that is at one of its most overvalued levels in history. So in this letter, if we go to the next chart, I dive in a little further into something that happened during the 1970s. Again, not a perfect comparable period, but it is important to see how we designed policy at that time. Nixon was facing a lot of pressure with the dollar, and he broke the gold standard because we were seeing the depletion of our gold reserves, given the convertibility at that time. And so we closed that window. We didn't allow that to happen, but that didn't fix the problem. At that time, they were worried by the fact that we were spending too much on the deficit front. By the way, the deficit was less than 1% of GDP. Today, it's 7% of GDP. And we were also supposedly deteriorating our trade balance, of which was 0 point something percent of GDP. And in some moments was actually flipped to positive. And so when you think about how he fixed that, well, he called it a balance of payments crisis. And he basically went on to put on tariffs of about 10% in some specific economies that were running a large surplus with the US. Those were Japan and Germany mostly, and forced them to basically revalue their currencies. In other words, strengthen their local currencies relative to the dollar substantially. And so that was basically how we saw the U.S. fixing its concerns at that time with the trade balance. And I think that that's maybe a framework that we should be considering in this environment. So when I look at a chart like this, it's almost like a line on the sand. This support that we've been seeing for some time now. I mean, the DXY index, which is what tracks the dollar. It's probably one of the most used ways to track the dollar. It looks at versus the British pound, the euro, the Japanese yen, and some others. And it's been hitting this support for some time now. Also, I would say I have a very different view from other people on this. I think a strong dollar, I don't think it's factually correct, actually. If you look at the chart of the dollar and the S&P 500, it makes sense that they actually move together. Now, the dollar receives a lot of capital. So U.S. dollar-based assets receive a lot of inflows, and you see that reflexivity playing its role in the markets, and an appreciation of U.S. assets tends to occur. Now, when you see the flip side of that, when what I'm trying to make the case here, of which we might be entering a multi-year decline of the DXY index or the dollar versus other fiat currencies, not just the dollar versus hard assets. That's one side of that issue. And I do think that that's going to become a policy, not even, a kind of a market mechanism that might kind of a escape valve, as we may say. And so I think we're in the process now. Right now, we're hitting into support again. And if you ask me, I do think we're going to break it, and eventually we're going to go a lot lower. So let's go to the next chart. Because one thing that comes to mind a lot is that, it's funny to see people talk about inflation is decelerating. And I think if we had other people, looking at our financial situation today, forget about the people that are so, fixated on today's economy. But no, try to put this into perspective. If you're, from the 1900s, and you look, and somebody asks you to look at the situation in the U.S. and they say that the U.S. is running a 7% deficit to GDP today, how in the world can you even claim that inflation is decelerating? It's just, it's impossible to see that type of behavior when you're spending that type of capital and flowing money into the economy of that degree. And so when I look at a chart like this, of which is comparing the waves of inflation in the 1970s with inflation today, I do think it's I think we're going to see something even worse than we saw back then. Not in the sense of, no, in here, it gives you a sense that we're in the third phase. I don't think we're in the third phase. I think we're going to see multiple phases here because of these structural problems we have in the commodities industry and some other issues that I will talk about it. But I do think that, claiming that we're seeing a deceleration of inflation, and the whole point of this is this situation with the Fed. The Fed having to lower rates as we see deficits unchanged. It's still a 7% of GDP, and we're seeing signs of inflation coming back. What are the signs? I'll talk through it, but you got money supply at all-time highs. You have the dollar weakening. I just talked about it. You have the deficits, as I just said. You have the big, beautiful bill that was just passed. Look into that whole bill. I mean, it's just telling you a green light for spending. And then the fourth one is, Fed lowering rates, and the commodities index is up double digits in the last year. So, I do think this is not in the data yet, potentially. And, the real inflation is obviously much higher than what's been reported if you look at the real world. And so I do think an acceleration is a very plausible thesis. Let's go to the next chart. So let's talk about a little bit about AI. AI is, I think it's going to create it's something unique. I like the comparisons with the internet. I like the comparisons with the real world in terms of productivity growth and in terms of, what this could mean for society in a lot of ways. What I don't like about those comparisons is that what is different about AI is that it does feel like a war environment where countries are trying to get there first. And nobody knows how this is going to land, right? I mean, we don't know how, if China gets, ahead of the U.S. in terms of technology, what would the world look like in that situation? Or another country, who knows, Russia or Europe. And so there is a sort of a need of an arms race when it comes to infrastructure development and making sure we have, the landscape to allow AI to also, take its place. On top of it, we also have onshoring. That a lot of reasons you can come up with that this is also kind of a wartime level of policy when it comes to the agenda from the Trump administration and others. Even Biden was supporting this too, and I think will be supported by any president in the near future. Is this attempt to bring back manufacturing in the U.S. and build factories and so forth. So when you put those two things together, I think it's going to create a world of spenders versus earners. The spenders are going to finance the infrastructure, and the earners are going to compound. They're going to be the ones receiving those funds and potentially, creating value in the economy. So that rotation out of one place into another place. And it is important to think about, well, how is this going to take place? Because, the government is broke. I just showed you a bunch of charts. The government can't afford this. So where is the money going to come from? Well, surprisingly, I do think there's ways to that we can see a lot of capital flowing into those areas. And I'm going to talk about 3 pillars that I think are going to be important here. We can come up with a lot more, but I do think simplifying the idea is important. There's 3 pillars of investments that I think are going to be really important in this arms race that we're about to see. Energy, And you can come up with ideas on natural gas. You can talk about solar panels. Some people like to talk about nuclear. Nuclear is a solution for the long term, not near term. And you can talk about a little bit about solar or the coal industry coming back and the revival of those aged assets. That's one portion. The second portion is the infrastructure that we need. And so you got utilities, how will the electrical grid look like? We're going to need to send energy, natural gas. So we're going to have to build pipelines, data centers, and all these things are being built already. Factories. And so the infrastructure is key. So the construction companies, engineering companies, all these guys, industrials, they're all going to likely to be receiving some of those funds from the spenders. And then the third one is, to me, the most arguably the most critical, just because of where we are in history of that industry itself. It's always been a legacy space, materials, raw materials, and it's just gone out of favor for a lot of I would say investors overall. I think Quinton has said this many times, and I like that idea of looking at geoscience enrollments in universities and all. I mean, there's so many ways you can think about how materials, that whole sector of the economy, have been, basically forgotten. And so, thinking about that way, that's another place that is likely to receive a lot of capital. You can come up with not just the metals and mining space. You can expand that a bit and think about steel producers or iron ore and all sorts of things, or cement. All these things are going to be very important to build this world of spenders versus earners, in my view. If we go to the next chart now, where's the money going to come from? Let's answer that question. I do think it comes from the top Magnificent Seven companies and the others. And there's a lot of ways you can think about this. I mean, I was curious, and I wanted to see, do they have debt? I mean, how much do they have in their balance sheets? Well, they have about close to $3 trillion in their balance sheet on assets, okay? And then how much debt they have? Well, in aggregate, they actually don't have any debt. Believe it or not, they are actually having a net cash positive amount of about $70 billion that they can spend. So when you hear all these ideas that they've been announcing, hundreds of billions of dollars of spending, if you just consider the fact that they may lever up their balance sheet, like any company would probably do in that position, take some debt. Well, they have room for that. You can have room for trillions of dollars if you want to. Over the next 10 years, it would not surprise me at all if we go from net cash to maybe 40-50% of debt to assets ratio. How many companies run their businesses with that level of debt? It's actually quite normal. And so I do think that that's where the money will be coming from, is leveraging the balance sheets of these large companies. So do not, I would say this very carefully, do not estimate what could come from in terms of capital raise of that part of the economy. The other thing we gotta understand is, well, how will valuations work with that? You're going to see a major deterioration of the health of the financial of these companies, right? Obviously the balance sheet is going to probably, if assuming I'm right, let's just make an assumption here. And you go from net cash to major amounts of debt in 5 to 10 years from now, where will valuations rest? Will they stay at 50 times free cash flow? I happen to think we're going to see a compression of multiples at some point, because I think that's unsustainable. That's where the money has to come from as well. And you can say, well, can they raise equity? Well, where's the money going to come from? The money is already there. It's like, 75% of the world index is in the U.S. So you're telling me that 25% is also going to come to the U.S. Well, I don't think that's really where the meat of these capital raise is going to come from. I do think it's going to come from leveraging up their balance sheets. So that's my 2 cents on that. Now you can go to the next chart. There's another possibility of where the money could come from. Their free cash flow. So if you think about their free cash flow, generating about $450 billion, right? So $500 billion every year these guys are producing now in free cash flow. Okay, well, we haven't seen the spending yet, like they've been claiming that we're going to be spending. 80% of that free cash flow is going back to shareholders today through buybacks or through dividends. Okay, well, there's room there. we can reduce that by zero, or maybe, that's an easy way to raise $400 billion every year that can be spent on the earners. So again, don't underestimate the possibilities that we have here to make changes in terms of where capital could flow. And so I do think this is going to be a huge rotation in this market. Anyway, let's go to the next chart. Now let's talk a little bit about inflation, because I dived in a little, talked to, think about the spending, think about the construction, all those needs. And look at this chart, for instance, something I've been looking at a lot, a lot of these surveys that come out for manufacturing, and they ask questions about prices being paid. And what is remarkable about the inflation data is that a lot of this reacceleration of prices that we're seeing is actually going into the service side. And so it's nothing to do with tariffs, actually. You can add the tariffs and say that tariffs are also, intensifying those trends, but it's actually coming from services. I guess it happens to be the case that when you're spending 7% of GDP every year on fiscal, expenditure, it does flow into the economy. And so I do think that that's the case. If we go to the next chart, you can see here, as I said before, commodities up double digits. I mean, that's the equal weighted index of commodities. So, some people will say, well, what about energy? Well, you need to look at the whole thing. And so agricultural commodities, metals have been going up a lot. And so, some agricultural prices or commodities have also experienced a surge in prices too. And so, I happen to think that energy is I believe in the rotation dynamic of commodities. I think agricultural commodities and metals have been kind of leading the pack here. At some point, it turns into energy. And so, I think that's important as well to think about. Let's go to the next chart. And then lastly is the situation of commodities versus inflation expectations. You have this alligator mouth again. Inflation expectations today are rising after this situation with the Fed. And I have my views in near term here on all this stuff that is happening. I happen to believe the Fed is not going to cut rates in the very short term. Of course, I think in long term, it's hard to believe they're not going to, because they have to. It's almost like we're fighting this fiscal dominance. Like, we have to lower rates to lower fiscal spending. It's crazy. And so, and forget about inflation, because inflation needs to run hotter than historical standards so we can deleverage the economy. And so I think that that's, a catch up on this divergence that you're looking at the chart there, where inflation expectation could be going along with where commodities are now. But anyways, let's go to the next chart. And money supply is the last thing on the inflation front that you can see here. Money supply at record levels. You can look at the year-over-year change of that too, and it's about 8% growth. So many ways you can analyze this data in terms of the reacceleration of the indicators that tend to lead to inflation at some point. And so, we're certainly still in an inflationary era. We're probably going to be here for maybe a decade or so. And the spending necessary for AI and all sorts of things is just going to feed into this whole idea as well. Let's go to the next chart. So now the idea, there's, ways to capitalize on these things. I said that I happen to really like that in materials section, because I think it's really undervalued. And I find it fascinating that we're starting to see some of those flows of capital coming into the space of gold miners. I thought that the beginning of this was going to be led to fundamentals improving. And now, fundamentals are improving. But I do think that a lot of the move in the miners in overall actually came from necessity. It came from, people starting to think, well, where are materials going to come from? It got to come from somewhere. I know, and they might not be the most profitable businesses right now, but maybe it still deserves or justifies an allocation. Well, guess what? Now they're also looking very attractive and compelling in terms of the fundamentals. They are improving substantially, especially in the last few years. Most of the miners are probably producing, gold specifically, at half of gold prices are today. All-in sustaining costs in the median basis is probably, still below 1500s or so, while gold prices are 3300 or so. So it's pretty interesting that fat margin that some of these companies are experiencing now. Anyways, let's go to the next chart. Now, let's talk about one thing that I learned from Pierre Lassonde. Actually, I was listening to a good interview with him in Gold Telegraph, and he talked about one aspect of why maybe we haven't seen the mining industry behave so well over the last decades or so. And he thought this was also maybe more of a long-term issue being caused by the pension funds in Canada. So I did more research on this because I was curious as well. And, basically about 40% of the precious metals industry today is, in the Canadian exchange. So it is a quite significant amount of their of the market. And so, lots of companies go there for many reasons. There's a standardized way of issuing your company in those places with 43-101s and all sorts of things that other countries don't provide yet. And so a lot of companies go there in order to access capital. And back in the days used to be the case. I mean, I think Quinton would maybe even be able to comment on that. But back in the days, the whole reason was because there was more liquidity. And that case has been shut down because there is no liquidity. And maybe the reason for it has to do with what's been happening with the pension funds money in Canada. Just to give you some sense, only about 4% of their assets is invested in domestic public equities now. And so, I thought that was an interesting number. And well, look back in other G10 economies, because why G10? Because most of the developed world countries have some sort of pension, more kind of a defined, formula for that. And so you have here, the U.S. is about 42%, not a shocker. Hence why we have so much capital in the U.S. And most of these other economies, if you just do the math, potentially the other side of their balance sheet is probably in the U.S. So Japan, 24% is in public equities in Japan. Where's the other 75%? Maybe half of it is in the U.S. I mean, it wouldn't shock me at all, even if it's more than that. Now you can run those numbers even further into these other economies too. Now, if you go to the next chart, all right, well, that 4%, what has been in history, and that was his point in his interview, was that used to be 30+%, almost 40% at some point, and now it's down to 4%. I'm only going back to the 90s here, and you can see that back in those days, the Canadian pension funds were a big, part of the market at that time. Just to give you some sense, Canada has about $2.3 trillion of GDP. The pension funds in Canada are worth they have in assets about $2 trillion. And so, it's a substantial amount. I mean, that would make an impact if we start seeing those flows going back from 4% maybe to 10%. That's to me, that's all optionality when it comes to investing in this industry. And I would say that, Russell Napier is a professor that I really listen to him. I think that's one of the best voices in the macro community. And what I like about him is that he talks a lot about this onshoring of economies, but not just the U.S., but potentially seeing this across multiple economies. And so, Japan seeing onshoring, Canada seeing onshoring, Europe seeing onshoring. And so think about all those pension funds that I said and the assets that they're investing in public domestic markets coming back, and what would that do to those markets? I do think that that's where you see that rotation out of the U.S. into those other places in a large way. So, that staying balanced. I think we're going to see this moving upward in the future. That's my opinion. Let's go to the next chart. All right, I'll go quick, putting my skates on now, as some like to say. Gold miners to gold ratio. Today, we're seeing a breakout of this trend. And this chart is good because I think it gives you some sense. I mean, have we seen, some miners are making all-time highs, some others are getting close to it, and it makes you think, I mean, have we seen most of this trend? I don't think so. I really think that in order to see that play out, we're going to see the money really flowing into and taking more risk. I mean, the normal bull market, what you tend to see is that investors gradually go up on the risk curve. They get more confident, they take more risk. And so we're not seeing that yet. We're seeing the beginnings of that. And that's one chart that you can see it. If you go to the next chart, you can see what's been happening more recently as well, where gold has been going basically sideways since April. I think it's more of a consolidation, nothing to worry about. But what is remarkable is that the blue line is the TSX Venture. Those that I guess follow the industry well know what that is, but that's, looking at the subgroup of precious metals. So that's, if you don't know, those are the very small cap companies in this industry. Most of them are exploration companies. That's usually, the higher risk that you can go in a spectrum of the overall industry. And so you're seeing that 30% move in those stocks as well. And so, at a time when gold has been going sideways. So certainly that's another way to see that investors are rotating from gold prices into those other areas that they're taking more risk and feeling more and more comfortable. And I do think that those are very clear signs that we're probably at the beginning of a bull market in the overall industry as well. Let's go to the next chart. I'm very close to being done. The last one is just putting into perspective of gold prices too, because I looked at the miners to gold ratio and I said, well, it gives you some sense about how, potentially early we are in this whole thing, and in a bull phase of the mining cycle. And where are we with the gold prices as well? Well, you can look at the gold versus the U.S. equities ratio, and gold is still very close to that undervalued or cheap, historically speaking, level. And so I suspect that we're also at initial phases of something that will take a very long term to unfold as well. And so to me, this is one of the most attractive industries to be deploying capital into. Obviously, our views. Obviously, let's go to the next chart. I think that's it. Maybe I have one more, but maybe not. No, Quentin, you take it from here, man.
Okay. All right, Tubby. Thank you very much. Now for something completely different. All right. So we have talked at great length about the whole notion of reduced intrusions. These are magmas at depth. They send up these little apophyses, and these things can be very, very, we'll say, robust gold targets, gold exploration targets. They often occur in clusters like you see here. I want to do a bit of a refresh today. Kevin inspired me yesterday from some comments about, talking about why we are invested in certain stories. And I want to kind of explain the underlying thesis. It's not just about geology. It's not just about geology, but geology drives a lot of it. Let's talk about this, because I think that this model that you see right there, the upside down udder, is basically the model that one should kind of plant in their head to think about these exploration stories that I'm about to talk about. Okay, let's go to the next slide. All right, of course, we're talking about reduced intrusive gold systems. These, there's different acronyms for them: reduced intrusion related gold, et cetera, et cetera. There's all sorts of acronyms. I don't care. Acronyms kind of drive me nuts, quite frankly. But the way I think of these are basically magmas, bodies of molten rock that were deep in the ground. They usually derive from melting, passive melting of lower crust. So it's not like they're, in an active arc terrain where you have subduction and stuff. These are often just melting when you kind of sag some crust down into a hotter thermal regime, and you get melting of lower crustal rocks. And these magmas then, they differentiate and they want to rise back up to surface, which is really interesting. I wish my lava lamp was going here. I just noticed my lava lamp burnt out. I'm going to have to find a new lava lamp light bulb, which I don't even think they make anymore. But anyway, you get the overall gist. Now, this is a schematic model that you see here. It is really just showing how these things are in place. They are like little fingers, or like we saw in the upside down udder. But the gold that occurs within them can actually take different forms. Okay, It can take sheeted veins, a form of sheeted in this model. You can also see breccias, the little triangular things in the middle finger there, if you will, where you get brecciated rock, which is simply broken up rock, and the fluids can percolate up in there and form gold. You can also get structures that kind of come off of the intrusion or feed off of the intrusion, and the fluids can find those structures and they can replace or rocks are joining the intrusion, or they can the fluids can flow out and into fractures and fissures that extend away. But it's a pretty simplistic model. Why do we use this term reduced intrusion? Well, it so happens the chemistry of these magmas is often say deficient, relatively deficient in oxygen. Okay, and chemically that means that these things have, we'll say, a higher fugacity or reactivity of sulfur in them and other things that can attach to gold and carry gold. So oftentimes we see a disproportionate amount of gold end up in magmas that are reduced. And I think that's why these things can be, they're basically vehicles for carrying large volumes of gold from the lower crust up into the upper part of the crust. Think of them as a giant cycle of gold. Think gold cycle. Okay, so these things are basically pulling out of the deep crust large volumes of gold and then reconstituting it at a shallower level, sometimes within reach for us to find and exploit. All right, but there's your upside down cow model. Think about all the different settings we have, because quite frankly, each one of these things tends to have its own little unique flavor. But okay, let's go to the next slide. And then I've shown this slide before too. This is really Craig Hart's geochemical zoning model. So instead of looking at this in cross-sectional view like the previous slide, we're actually looking at this thing in plan view. So we're looking straight down, from top down. And the pink thing you see in the upper left there, that is your intrusion where it's expressed at surface. Obviously, if we're seeing it exposed at surface, Mother Nature must have eroded down into that granite body to expose that. But you can get sheeted vein complexes in an intrusion like that. So you can see the little black lines there. Those are represent gold deposits. Usually when you're in the core part of the system like that, you see gold, bismuth, and tellurium. Sometimes tungsten too. I've even mentioned tungsten in a few examples. Like at Sitka, they have a lot of scheelite popping up in a lot of the core. All right, so basically you have the intrusion itself as a prospective host, but you have the rocks around it. So extending outwards, you have these zones of geochem, and those are where the veins and whatnot take the gold out into the country rocks adjoining the intrusion. You can have arsenic gold systems extending outwards, and then beyond that, arsenic antimony gold systems. SP is antimony. And then even beyond that, you can get silver rich systems with base metal, so silver, lead, zinc systems. Classic district for this kind of zonation, and this is really where this model was derived, is actually around Mount Hinton near Keno Hill. So Keno Hill, many folks, Craig Hart included, view the high-grade silver base metal deposits there as being the distal expression of a reduced intrusive, and the reduced intrusive in that particular district is believed to be over at Mount Hinton, which is where one of our companies, Trifecta, is actually exploring. Anyway, don't want to digress, but this shows you kind of the overall pattern that you might expect. There's a few little nuances in here I might point out, like lamprofers. What the heck is a lamprofer? Well, a lamprofer is basically, it's usually a dike-like body, so it's a magma that came up with small fracture. And lamprofers often have a composition that indicates they're derived from way, way down in a mantle environment. And why are they important? Well, because if you see lamprofers, it means that the cracks in that particular area must have been really deeply rooted. And usually people view that as a positive for gold, positive for the emplacement of gold systems. So lamprofers always kind of get geologists a little excited. The other thing I would point out is that this model, while it's we're looking at it in plan view, it can also be applied in cross-sectional view. If you can imagine tipping this up, you'd basically have the gold, bismuth, tellurium central to the intrusion, like the fingers we saw in the previous image, and you'd see this zonation extending outwards from there. So don't think of it in just a very 2D way. It's a 3D model. All right, let's go to the next slide. Okay, I would argue, and this is kind of the fundamental point of this whole presentation here. I would argue that the gold industry, and I'm talking in general, the gold industry needs a new generation of gold discoveries, gold deposits that it develops over the next few years. And I've talked about, the fact that the Tintina belt, the Tombstone belt, some people call it the Tintina belt, which extends from Northwest Territories through the Yukon over into Alaska. It has a large number of these reduced intrusives. So these things tend to occur in districts. Is that to say there's no other district like this around the world? No, there are. There's some in Australia. There's some in South America. There's some in Siberia. There's some in, they're sprinkled all over. There's some in China. Anyway, these intrusive type, reduced intrusive type gold systems are real. They really occur over a broad geographic, setting around the world, or they occur across broad geographic settings throughout the world. Now, I would argue that the reduced intrusive type systems are discovery friendly. What does that mean? Well, if you think about Snowline, when they had the Valley project, but prior to any drilling, the data that they had was really just lightweight superficial data. They had a few rock chip samples, they had some soil samples, and they could see the sheeted veining in a few outcrops. Okay, and that was enough. That was enough to go, you know what? We should poke some holes in this. In other words, it didn't take a lot of brain cells to go, and that's not to mean anything disparaging to anyone. It just means that it was a no-brainer of a target. Okay, it was, hey, let's walk up and drill this target, and they did, and it's been a wild success. Okay, and since that time, we've seen, one after another discovery of this type made. All of them tend to have sheeted veining, at least the targets, most of the targets we've talked about. So that's, visually, that's a very important aspect, very easy, discovery friendly indicator. They tend to have the bismuth and tellurium signature, maybe a bit of arsenic, things like that, but they tend to be walk-up drill targets. Look at Rackla. They staked, I kid you not, they staked Grad last year about this time, and they're drilling it. They're already drilling it because it is that friendly of a target. They didn't have to sit there and do, millions of dollars of geophysics and other stuff. They said, wow, look at all these sheeted veins, and wow, look at all this outcrop, and let's drill some holes. All right, so they're discovery friendly. They are also big assets. Okay, these reduced intrusive systems often lend themselves to becoming tier one assets that are capable of producing. And in I set the bar here, I put it at 400,000 ounces. Is that a magical number? No, it isn't. But I would say that's the kind of number that you need, or a major mining company needs these days, to make a meaningful impact. Think about it. Newmont is not going to go around wanting to develop a bunch of 100,000 ounce a year producers, because it really doesn't have that big of an impact on the bottom line. But a Newmont is sure as heck going to want to find a 400,000 ounce producer, because that's, it's a little less than 10% of the current production, but that's meaningful. Okay, that's something that justifies a big company spending their time and effort, money, and so forth. All right, so it's gotta be big, baby. Okay, so tier one assets, and that's very typical of these reduced intrusive type systems. They also tend to have long mine lives. They can be 20 plus years. I mean, look at Fort Knox. I think I was at Fort Knox the day or pretty close to the day they opened in 1996. I think it was Q3, is like September-ish or maybe August, can't remember. But that's not quite one, almost 20 years, and they still have several years left. So look, these things can have very long mine lives. They tend to be high margin, okay? And I'll talk a little bit more about that in a couple slides in the upcoming slide deck. But these are very, very profitable deposits, mainly because they have such friendly metallurgy. The gold is what we call free milling. What does that mean? Well, it means The gold is not locked up in sulfides or some other mineral phase. The gold is actually accessible to various forms of milling and even heap leaching that are cheap, friendly metallurgical techniques that make these things very high margin. Okay, so metallurgy is very key, and I always push companies, if there is no metallurgy, I push companies to do that metallurgical work to demonstrate they have the goods. Okay, that's an important aspect. They also tend to be relatively low capex. You might say, well, gee, look at, Snowline's going to be north of $1 billion. Yeah, but you know what? For the scale of mine you're talking about here, something that's going to produce hundreds of thousands. In fact, the first few years at Snowline, I think is like 600,000 or 700,000 ounces a year. $1 billion point X capex for a project like that, that's pretty darn good. In this day and age, that's mighty good. Okay, it's not a $10 million project. It's a, 1 point X billion, and that's manageable. And that's manageable for large mining companies too, which is very important because these exploration companies want to deliver a product to that major mining company. In other words, a discovery that's appealing, and relatively low capex certainly make them appealing. I would also add they can also be scaled up. Okay, most of these systems, you could develop them at a certain tonnage and throughput, and then actually ramp them up too, which is one of the unique or not unique, but nice attributes of these types of deposits. Okay, now environmentally friendly. What do I mean by that? Well, these systems tend to have very low sulfides. Okay, what does it mean? Well, it means they don't tend to generate huge amounts of acid and things like that. In fact, these often have a bit of carbonate mineralogy to them too. Carbonates tend to buffer acids and stuff like that. Quite frankly, most of these deposits end up being nothing more than glorified granite quarries. Okay, they are pretty innocuous rocks that we're dealing with here, and because of that, aspect is reclamation friendly. What do I mean? Well, you don't need, you don't have to do a lot of magic chemistry to reclaim these. You don't have to put lime and other stuff on top and new headaches. These things can be reclaimed in a relatively cheap, straightforward manner, which also and very thoroughly too. I think, like you can basically have usable land after you're done mining. Okay, so I think that all of these things really make for good gold deposits that the gold industry needs. And that's one of the reasons I kind of champion this particular type of system. Now, what am I going to do today? I'm going to ramble through stories. Many of them I've talked about before, but I'm going to kind of re-emphasize. I'm not going to necessarily do updates per se. If there's an update to tag on to what I'm talking about, I'll talk about it. But I'm going to basically kind of go through the thesis for most of the intrusive related gold systems that we have in our portfolio. All right, go to the next slide. And of course, I've got to start with the example, the granddaddy of them all. This is really the one that sets the bar. This is the Fort Knox gold mine in Alaska. It's not far from Fairbanks. One of the things I'll point out about this mine is notice how the pit is relatively smooth. I mean, it's very repetitive benches, relatively long continuous runs. Why is that? Because this deposit is so big and so predictable. It's just like mining a bowl of soup. Okay, I mean, truly, grade control in this thing, like your average grade control geologist in a deposit like this is going to be like the Maytag repairman. They're just going to be bored to death because they are so continuous and so predictable and so consistent. That's their nature. All right, let's go to the next slide. Huge pit too, by the way. Here's a cross-sectional view through that deposit. What is it? It's really just a bunch of sheeted veins, and you have some, in this case, that are vertical, some that are more flat line, not horizontal, but low angle. And you got different phases of granite there. Yeah, is that a big deal? No. Oftentimes I guess what I would say is these intrusions often come up in pulses, so you get different intrusive faces, but the point is you basically just have a big cloud of veinlets or small veins that kind of find their way through the rock and make large volumes of low-grade mineralization. They're wonderful deposits from that respect. All right, so there's Fort Knox. Notice the scale too. That's 50 meters down there in the lower right. So really, if you took that across the section there, it's probably 600 meters from east to west, or I guess south to north. These are big deposits. They have huge volumes. Huge volumes. Go to the next slide. This is an aerial image of Fort Knox. The pit is actually down there in the bottom center. You can see a little bit of water in the bottom of it. So that's where the rocks derive from. But just to the north of that, kind of where that triangular wedge-shaped thingy is, that's where the heap leaches are. So they do heap leach some of the rock here. So low grade, they stack it. They don't crush it, or they don't mill it and stuff. They just maybe do a light crush. Some of it's just run a mine, stack it up, and they sprinkle solutions through it, and voila, the gold comes straight out. Okay, so there's heap leach. But if you look over here, just to the right, upper right of center, you'll see a cluster of buildings there. That's the mill complex. And they do mill the higher grade material. When they say higher grade, at this point, we're talking like half gram or, type stuff. They will put that through the mill. Mill tailings actually are stored over here on the far right. So the area that's kind of turquoise blue is basically your mill tailings compound or, storage facility. You have a hybrid milling heap leach. That's pretty typical of these types of systems, and cheap too. Emphasize cheap. The gold comes out well in the heap leach, comes out very well in the mill. You get gravity gold. The rest of it comes out through cyanide solution. No problem. Great recoveries. All right, so that is a great example. Now, what's going to happen to this mine once it's all done? Look, one thing I point out straight away, you don't see a lot of bright oranges and reds and stuff. If you did, that would be oxidizing pyrite. Do we see that here? Not very much, hardly at all. Okay, that means that they can simply contour the surface, smooth it out, put topsoil over the top, and basically it's a usable piece of land at that point. Okay, these are not environmentally challenging deposits to reclaim. Right? So I'd say in 20 years or 30 years or whenever they're done here, you would come back here and you would see some forested hills. That's pretty much it. All right, let's go to the next slide. Okay, so this array is a number of our intrusive related gold systems. I hesitate saying reduced because they're not all entirely reduced, but in general, they're in that genre of geology. And these stories are at different stages in discovery. Some are well advanced. Snowline is well advanced. Banyan is well advanced. Others are kind of not incipient, but they're definitely in the middle of a discovery, like Sitka and I think even Rakla at this point, Altamira for sure, and even Tectonic up there. But then we have early stage ones. Maybe Rakla should be called the early stage. I don't know. Anyway. Trifecta for sure, Onyx Gold for sure. Those are early stage. So we got kind of a spectrum, but each and every one of these has, in general, the same style of system and is chasing the same price. Okay, which is what I mean is, has the attributes that were on the slide a few slides back. It's going to be major gold discovery that can be built into a tier 1 asset by a major gold mining company. All right, so I'm going to go through these real quickly. Let's go to the next slide. Okay, with Snowline, this one slide they have in their deck, I think, sums it up. It is tier 1 scale. You can read all these bullets. I don't want to sit here and read all of the slides. I think one of the most amazing things, though, about this deposit is how consistent it is. Look at that first pit. That first pit is diving in on that high grade. It will absolutely kill it. I mean, that thing is going to just puke gold, which is amazing. I think their production is, again, like 600,000 or 700,000 ounces per year the first few years. And even beyond that, once they expand out into the other pits, you're still looking at just an absolute ocean of mineralization there that will be mined for many, many years. Okay, so this has, if you read through all of these bullets, talks about, various aspects of the economics and the metallurgy and da-da-da-da-da. And you'll see that everything that's listed on that slide is pretty much addressing what I had a few slides back. That is your classical high value asset that gold mining companies need to be looking at and focusing on. That's our next generation of mine. Okay, let's go to the next slide and let's talk about this this project a little bit more. What's really interesting in my view about these systems is they can deliver surprises. Okay, and the big surprise that I think Snowline has delivered recently, they've drilled Valley, and they've done a great job. They're advancing it towards becoming a mine. That's the pit over here on the left is the Valley pit. But look at over here on the right. What do they have? They got a drill hole that they just drilled recently that hit, surprisingly hit just a big whack with visible gold down it. Do we have assays yet? No. But is that likely a new discovery? I would say, yeah. I think they're onto something new. Very interesting. What is it? Don't know yet. But could it be big? Well, imagine maybe that hole's the first hole into what you see on the left. Okay, take that, boop, put it over here, bloop. Maybe that's a new one. That's the kind of growth you can see out of systems like this. A one drill hole discovery can quickly evolve into something absolutely enormous. Could this be a double? I don't know yet. There's not enough data, but to see a drill hole like 143 there that looks as good as any of the drill holes over there in the Valley deposit, and knowing there's nothing else around it really, that gets you fired up. Okay, so good on them. Let's go to the next slide. The other thing people should take away is that Snowline is one of the biggest landholders in the east central Yukon region. Okay, they have huge property position that encompasses absolutely, a huge inventory of these reduced intrusive targets, and they are testing many of these this year. Okay, this company is not sitting still. They're not just going, oh well, Valley's it, we're all good, enough said. They are out there drilling and testing many targets this year. So I think we're going to see even more good news. Talked about this, I think, on the last video. All right, go to the next slide. All right, Tectonic. Tectonic has not put out a huge amount of news. I got to say, it's been a bit of a like anybody home kind of situation, but they are drilling like mad, and they just raised a huge pile of money. Okay, that's interesting. What are they chasing? Well, they've got this flat gold project. You can see it's located in western Alaska. It is fairly remote, but it's near Donnelly Creek, which is a big gold development project. I think to the south from Flat. But they have a property position that's to die for. Okay, they have these reduced intrusions. You can actually see on the right the blue blotches you see there are basically a sequence of reduced intrusions that extend up through the axis of their property. And they have innumerable targets across the property, all of which have derived alluvial gold. And the pink that you see in the middle, that basically tabulates the amount of alluvial gold that's been produced off of the property over the years. This is a big alluvial gold field in Alaska. That's exciting. Okay, we know there's a bunch of reduced intrusions here that are kicking off gold. Has this thing been thoroughly explored? No, not at all. Okay, that's that's 20 kilometers or something, I think, from north to south. It's barely been scratched, but the company is giving it an aggressive test this year. They started drilling earlier. Thank you very much for starting in June and not the end of August like they did the past 2 years. And they're giving it heck. Okay, I know they're drilling like mad. I mean, the last time I had an update was probably early August, I think, and they had I think something like a couple dozen holes drilled, most of which were up in the Alpha Bowl and Apex are basically north of Chicken Mountain in that area. Why would they drill that many holes? Well, I don't pry and I don't pretend to know, but usually when you see something good, you keep drilling. So my hunch is they're onto something, and they're keeping their head down and drilling away. Let's go to the next slide. All righty, here's a little 3D rendition looking, I think it'd be northeast. Yeah, we're looking northeast. Shows the soil anomalism in gold across Chicken Mountain, but you can see it extends all the way up to Alpha Bowl there as you go further to the left. That's where the biggest alluvial gold deposit was found at Flat Creek, 650,000 ounces. And last year they hit 1.22 gram gold over 60, I think it was 66 meters there. in the first ever drill hole, like right under that placer. And to me, and that was the entire length of the hole, by the way. But to me, that smells like they basically made a discovery. Okay, now I think they're drilling a lot there, but I also understand that they're kind of stepping back towards Chicken Mountain here as well and drilling holes. And look, I'm not going to pretend to know how this is all going to play out. I don't. But my hunch is, based on the soils and the extent of the intrusive bodies as expressed by the magnetics in the previous image, I would say that this is all one big system. I think it's dangerous to start talking about, oh, well, Alpha Bull is different than Chicken Mountain is different than, whatever. They're all the same thing. Okay. They're all part of the same system. And I think there's enough room here that this is going to be an absolutely extraordinary discovery at the end of the day. All right. So very anxious to see how this plays out. We're dead keen to see the results come rocking in. Hopefully we see some, now that they got their placement closed, hopefully we see some more news come out of the company. But very excited about this story. Go to the next slide. One of the things that we at Crescat pushed them to do early days was do some mat work. This just goes back to what I was saying in one of the beginning slides there, is that metallurgy, knowing that metallurgy is friendly, knowing you can get very good recoveries, 96% average gold recovery, and very low cost techniques. In this case, we're looking at leach kinetics with different composites of oxide, and there's no sulfide in this, but anyway, you can see very, very quick leaching of gold out of these rocks in a very, very, very short amount of time, very low reagent consumption, stuff like that, very low sulfur content, etc. This is the kind of stuff we want to find. Let's go to the next slide. By the way, if somebody asked me, would I rather have a Donnelly Creek that's running 2.5 grams gold but is refractory, or would I rather have a 1.2 gram gold that's non-refractory? I'll take the non-refractory any day. All right. Now Sitka, I'm going to jump through these companies, right? Sitka, this image it should really stick in everybody's head, because if you think of the upside down cow model, you can basically see, boom, boom, boom. We've got all of our teeth sticking up here. Okay, we know that they're poking up through the terrain. Blackjack's already a resource. It's growing. Eiger, resource, growing. They've even found mineralization between those in Saddle, growing. Pokemon and Contact, they just announced news this week. Really nice visuals out of Contact. No assays yet, but some really nice holes coming out of there. A couple of weeks ago, they announced from Rosgobble some really nice long intercepts. You can see some of the first deep holes at Rosgobble are showing gold way down. So what is this? This is a discovery in the making. Okay, this is going to be big. In my view, this will be a very, very big collection of deposits. Yeah, they appear to be discrete, disparate deposits, but think about it in the third dimension. What's going on down deep? Don't know yet. Would all these connect? Probably. They're all derived from the same magma. What does that mean? I don't know. Could this be big? Yeah, I think so. I think it could be, have an endowment, say 10 plus million ounces. I don't think that's a problem here. It might be in different, forms. That's all right. Is it metallurgically friendly? Yeah. Look, every indicator so far is the gold occurs in the typical way you would expect to reduce intrusives. Little particles and small veinlets. It's all free of, sulfides and It's the right stuff. This is a discovery in the making. It's going to be big. All right, go to the next slide. This is a plan view of that. The cross-sectional view that we looked at was kind of going north-south through here, but you can see how these teats are just arrayed across the property. One of the things I was really encouraged about in the news release that put out this week, not only the visuals from Contact, but I was really glad to see they're going to drill a bear paw. That little target, it looks little, okay, but that bear paw breccia, if you look at, there was a couple historic holes there, 45 meters of 1.69, I think it is, gram, and 52 meters of 2.25 gram. There's some nice holes down there. And after being at the property, in my view, is that is very, like it's an unexhumed intrusion. Like it's just, right below. I think there's a perfectly preserved target immediately below that pipe there, breccia zone. So I'm very excited about that. Anyway, they're going to drill all of this stuff this year, and maybe even more so. There's a Maiku target off to the east. It's not on this map, but that also looked very interesting. Even what's right here, guys. This is big. This is big. I love this story. Go to the next slide. And then this is just some of the core that they put in the news release this week. It's interesting because the rock here, it's kind of a black laminated stuff. That's, the schist or the country rock around the intrusion. This is not actually out of the intrusion itself, but this is from what they call the contact zone. The contact meaning where the intrusion is in contact with the sedimentary rocks and has baked them up. There's little veinlets that have snuck out into the schistose rocks like this. And those quartz veins, look at the gold in them. My gosh. I mean, that's just dripping with gold. It makes you think, gee, if there's some place where all of that comes together, maybe it's a little bit deeper, maybe it's over in the intrusion right next door. I don't know. But imagine finding that kind of gold in a lot of veinlets, very tightly spaced veinlets. Could be rich. Okay. Looks very good. Go to the next slide. Okay, here's our enigma story, but absolutely riveting story. Rakla is drilling away. This is the one I mentioned where, the guys staked it last year and they were like, wow, look at all this sheeted veining. And they sampled and they got up to 92 grams per ton on some of the first sampling they did last year. I remember looking at that rock and thinking, well, where the heck is the gold in this thing? It was just a piece of granite with little sheeted veins in it and small specks of bismuth minerals. And it's like, how the heck do you get 92 gram per ton in a rock like that? I've not seen that happen before, but it does. Okay. And in this case, they have been drilling like mad. I think they're on a hole, 8 or something here. And what they're trying to convey to people is the density of sheeted veining that they're seeing. They can't say, oh, we see visible gold, because you don't see visible gold so much here. It's the bismuth minerals. You see these little gray specks. I mean, like little tiny fly speck bismuth stuff in these veins. That's it. You don't see the VG like you do at Snowline, say. But they can sure as heck count the number of veinlets they're getting, and they are seeing very high densities. Notice many places over 20 veins per meter. And notice like hole, 3, some of the best veining is at the end of the hole. Holy cow. Like it doesn't stop. They ran out of drill rods, but it keeps going. All right. So that's interesting. And then even some of the recent holes over here, like 6 and 7 and stuff, absolute tons and tons of sheeted veins. Why is this important? Well, because, as geologists, we tend to associate the density, how many veins you have, say, per meter, with what you might expect grade-wise. Can I prognosticate? I can even tell you what the grade is? No, I don't know. Don't know. We got to wait for assays. Got to wait for assays on this one. This one is just a nail biter. Okay. But man, is that big. That is big. Okay. Let's emphasize that with the cross section. Go to the next slide. This shows a cross-sectional view. Bloop, so we're looking at the drill holes in the vertical sense, and look at how far that goes down. Like the start of those holes is what, about 1750 RL, and they go down to 1350 RL there. Hole number 7, I think it is. And they're still in veining. The volumes of rock you're seeing here absolutely equal to Fort Knox or any of these big systems. Okay, so if this has gold in it, we now can, by the end of the season, we can put our hand to heart and say, yeah, there's a lot of rock there with gold in it. Okay, so very exciting. Let's go to the next slide. And then this one really caught my attention because this shows the current thinking around the drilling they're going to do. So they got the drill holes they've either finished or are drilling right now are the ones with the little blue dots and the black lines. Okay, but they have these ones with white, and they say pad E and pad F and pad G. And then they show the white trace. Those are planned holes. What is that telling you? Well, first of all, pads F and pad G are actually down in the valley. So they're going to have the advantage of being low, and they're going to drill long ones. Those are big boy holes. Those are holes that go down, 700-800 meters. We're going to see how deep these the sheeted veining actually continues. It could be a long way. And then pad E up there, That's going to be the northernmost one. And again, the length of that puppy is huge. Okay. You know, you might think, well, gee, it's a higher elevation. It's not going to reach the same depth. No, it's actually going to be deeper than the ones that they've already drilled. Okay. So what's the takeaway here? The company must be excited to commit to doing this, because this is a lot of work, a lot of money, but they're excited and they're going to do it. I love Simon's approach here. Swing for the fence, baby. Just if there's a big gold system here, let's figure it out this year. Does that mean they're going to have a resource by the end of the year? Absolutely not. That's crazy talk. Okay, but could they say we've got something that's about 700 or 800 meters long and about 600 or 700 meters wide and goes down 700 meters? Yeah, they can, by the end of this year, if the assays come back, they can start to kind of arm wave around, what's here. Pretty cool. All right, let's go to the next slide. Okay, bang it. Well advanced story. I struggled with this one for a long time, but I was up there and I saw the work that they've done more recently around domaining and revising their model. Look, I don't expect anybody to read the numbers up there in the corner. Sorry, they're so stinking small. I reproduce them elsewhere. I'll show you in a minute. But the takeaway here is the footprint of this system. You see the scale down there, like that bar is 2 kilometers. Okay, so this thing from east to west is like 4 or 5 kilometers in size. Huge. Okay, that's bigger than Fort Knox. Now the yellow is where they have indicated, the orange is where they have inferred. This is an enormous gold system. And the other thing I'm going to point out, go to the next slide, is that right now everything they define is like a thin skin. Okay, think about this for a minute. That's a thin skin, and that's largely driven by just the depth of drilling. Does it mean there's nothing below? No, there's plenty. There's probably plenty below that. Okay, you got something that's kilometers long, and they've only drilled the little veneer, and they've come up with millions of ounces of gold. Now, in this particular case, you can see the numbers there. Yellow is greater than 1, red's greater than 2, and pinks are greater than, 1 to 2 is red, and then what would that be? Pink is greater than 2. There we go. That's how it works. All right. So what's changed about this? Okay, the domaining. Okay, see how it's like little layers in there? They've actually started to define and domain the rock and the gold better, in my view, and it's really helped with the understanding, the confidence around this thing, but also the grade. I think that's a big part. Okay, what's the upside? Huge. This thing could go down in the ground a long ways. It could expand along strike. There's nothing closing it off on either end. This is an absolutely enormous gold system. It's almost hard to conceptualize. Go to the next slide. And by the way, it's in a great location jurisdictionally, infrastructure wise. There's lots of infrastructure. Go to the next slide. We're going to look at the numbers real quick. I'm going to highlight 2 numbers. So at a 1/4 gram cutoff, if you take, and I can do this, so I'll just chuck it in there, but you can take your inferred and indicated. So the one there on the left, the 1.8 million ounces, and then over here you got 5.9 in inferred. We're already, 7.7 million ounces or something right there. 1/2 gram. Well, that's better than the average grade at Fort Knox right now. Okay, so that's pretty good. All right, but if we look at higher cutoffs, in other words, we kind of look through the forest and see the trees there, you can see it like a 0.55 gram cutoff. You got 1 million ounces indicated at 0.92, and you got another 2.9, almost 3 million ounces at 0.97. Guess what? When Fort Knox started as a mine, and I was standing on the first friggin' bench, it was 0.96 grams per ton. That's the same grade there, guys. I'm telling you, this has every aspect as big as Fort Knox, and it should be a good mine. All right, go to the next slide. Trifecta. Oh man, this news came out in a very timely fashion. It came out actually a few, like 2.5 or 3 weeks ago. There are times when things slip past me and I feel like a dork, but whatever. They got their drill permit for rye. Okay. They've also been doing work out there in the sheeted veining. Look at the sheeted veining in this granite. Is that not to die for? Oh my gosh. Okay. They will, I hope, be drilling this because they got their drill permit granted for rye property. I know it was a battle for Richard to get this. He was pulling his hair out when I saw him in early July, but he pulled it off, baby. And they're going to go drill. And I would say, look, the way I could see a story like this unfold, maybe they drag a drill over there. By the way, this is, over in eastern Yukon. Maybe they drag a drill over there and they drill 3-4 holes like Snowline did back in 2021. Just quietly drill them and then come out with big intercepts. And like everybody goes, oh, that's interesting. And maybe we all get lucky. That's my hope. I think this project looks very good. Okay, let's go to the next slide. Okay, Onyx is even doing work now. Yeah, they've refocused a lot of their effort back in Timmins because they got the discovery at Crisis. But to be frank, the big emphasis was this King Tut project, and the Golden Mask and Main Tut zones and Raw are all getting a good shake this season. I don't think they're going to drill. Okay, I did talk to the company back in early July. I don't think they're going to drill, but I think given the work they're doing, we might see some new information come to light. They're doing a lot of saw channel samples and things like this across sheeted vein zones. And I hope that we see them announce, some long channel samples, hopefully with good gold grades. You can see the distribution of gold anomalism across these intrusions, very robust. It reminds me a lot of Valley. So not a drill discovery yet, but at least they're advancing and they haven't forgotten about it. Let's go to the next slide. Okay, now I'm shifting gears. Okay, we have just left the Tintina Belt and we have taken a long plane flight to Brazil. Okay, in this Cajueiro district, which belongs to Altamira Gold, is basically a very similar style system to what we just talked about, albeit much, much older. These rocks are 1.x billion years old, where the ones up in the Yukon and Alaska are more like 100 million years old. But nonetheless, they're the same types of system. And what are we looking at here? Well, the company's done a really good job expanding from their initial discovery at Cajueiro Central and expanding and finding more and more targets across the property. Again, think upside down cow. You've got a whole bunch of teeth sticking out of the ground here. Absolutely amazing. They're all very similar intrusive rocks that are poking their way up and generating these gold anomalies. Okay, why is this important? Well, look at the scale on this thing. It's absolutely huge. Like, that's 2 kilometers down there at the bottom. Like, from east to west here, we're looking at 15 kilometers. North to south, we're looking at 10 kilometers. This is an absolutely enormous udder, if you will, that's kicking these things off. That's why I get excited about this. Is it super high grade? No. But in this part of the world, met friendly, large volume, we know that Paracatu mine, for example, Kinross's mine there in Brazil, average grades like 0.4 something gram, absolutely pukes money at this price. And this reminds me of one of these just huge volume gold systems that could rival something like that. Okay, so let's go to the next slide. Here's what we're dealing with. You can see in photograph, we got this porphyry intrusive phase. So it is a quote porphyry, but don't let that bother you. It's the same flavor, okay, and it's very low in sulfide, so there's hardly any pyrite and stuff. It's got the little sheeted quartz veins riddled all through it. You can see them everywhere. Some are black, kind of like on the right hand side, and some are more white, like you see in the middle. But they're all little gold specks and stuff, very in this type of sheeted veining. It's the same beast, okay? And these guys, yeah, they drilled some shallow holes and they put a resource together, Maria Bonita, but where are they headed? Well, I'm going to tell you. Okay, let's go to the next slide. Okay, again, push metallurgy. They did it. They did a great job doing metallurgy, and you can see everything they've done to date shows that, agitated leach, very high recovery, column leach, which is effectively a proxy for heap leach, good recovery, quick recovery, Basically, this is free milling. Remember the free milling? See the red circle there? They are in that regime. That's why a project like this, even though it's low grade, will work in Brazil, where you have good power supply and relatively cheap power and stuff like this. Okay, let's go to the next slide. Okay, so this is the same image I showed at the beginning of the Altamira Prezzo, but it's zoomed in. Okay, and I clipped the little resource tables for Cajueiro Central and Maria Bonita, and I pasted them in there. Okay, so the two little tables that you see are the resource. Now notice at Maria Bonita, they have some oxide and they got some sulfide. When they say sulfide, it doesn't bother me because the sulfide here is not refractory. So it's basically, it's almost like saying the same thing. Don't let that even bother you. Okay, but if you add up the numbers here, they have on the order of 700,000 or 800,000 ounces of gold in inventory over here at Maria Bonita with just a few shallow drill holes. That's crazy. Okay, a few 200 meter drill holes, and bam, they've already got a big resource. Over here at Cajueiro, which is where they focused all their effort initially, and good on them, but they have about 700,000 ounces if you add up all the numbers over here at Cajueiro. Okay, so right now we're already at like 1.4 or 5 million ounces, but they've tested maybe 20% of what you see here, and plus what's happening at depth. Okay, what's going on? Like if they drill deeper holes at Maria Bonita, what are they going to hit? Don't know, but they could hit a lot. Okay, the volumes of rock that are likely present here are absolutely jaw-dropping, and I think that this is, and the placer coming off, huge amounts of placer gold, just like all of these camps. This smells like a big one. Yeah, low grade ish, but that's all right. Here, it's going to work. It's going to work. All right, so go to the next slide. I think that should be the end. Now, before I totally bag it here, guys, I do want to do another prezzo here soon, and I'm going to kind of give a preview about what I'm going to talk about. Everybody knows we love left-hand side of the Lassonde curve. Okay, everybody knows that. That's our favorite place, or my favorite place to play, and we have lots of stories in that space, and it's been exciting. I've got a right-hander for you. I have found the ultimate right-hand story, and I will be talking about it next time. Okay, so Kevin, that's your warning. That's what I plan to speak about. It is a development project that has just gone through the dippy-doo, the low point in the Lassonde Trough, and has raised all the money they need, and they have all the permitting they need, and is about to build a mine, and will, in my view, see value added to the story as they develop that. Okay, so we have a right-hand story coming your way. We'll see if anybody can guess what it is. All right, I'll shut up now.
Awesome. Thank you, Quentin. So as most of you guys know, we have a number of these reduced intrusion style systems in our portfolio, and Quentin just went through them all. We're just really excited about the drilling that's going on right now across all of these companies and the assays that are, I think all of them are still drilling or about to be drilling. But especially the ones up in the Yukon and in Alaska, the drill season got kicked off in late May, early June, but the backlog at the assay labs, the assays really don't start. Well, you've seen assays coming back from Sitka because they got a really early start. They started in the winter, but the assays are going to be coming in like crazy over the next several months here still, and that's what we're really excited about with most, if not all, of these stories. And so stay tuned. Again, if you're interested in learning more about our strategies, please go to our website. Please talk to Merrick. You got a letter coming out. Tavi just gave you a little bit of an overview. Tavi, any final comments here?
No, I was going to say where to start, but really where to end. But this week so much has happened, and I think that if I would have to point out, I've been trying to do this exercise. What's been the biggest thing that happened this week from a macro standpoint? I would say that's been this, the resumption of the resuming of the dollar decline recently. I mean, we bounced into that support in the long term, and now it's going back down again. And I do think we're at a critical level here. I mean, it could happen next week. It could happen 2 weeks from now. Who knows? But once I think we break, of which we're so close, it's gonna, in my view, it's gonna mark officially the beginning of a downward trend, and that unleashes so many things. So I think it's very exciting what's happening. So and keep in mind, the euro has done it already. The British pound has done it already. And I think that there's some others that will probably do it too, but it's very exciting. Anyways, I won't keep this longer, but thanks everybody for watching. If you have any questions about Crescat and what we do, you can speak with Merrick. If you enjoy these videos, you can always follow us on YouTube or Twitter, or X, I should say. But anyways, thanks everybody for watching. We'll be back in 2 weeks. Take care.